Much like in sports, follow through is very, very important in investing. In golf, basketball, tennis, or even bowling, it is not just hitting the ball that will be important. It will be the way we will move the racket, the club, and even our fingers when we shoot the ball. Your follow-through will determine your rate of success and your level of performance. That is also the way it is in investing. It's not just a matter of making an investment. Since it is a program and a strategy, you will have to follow through. So let us try and make sure you're doing that now. Hi friends, this is again Rex Mendoza from Rampver Financials. I hope you and your loved ones are all well, healthy, and thriving within the pandemic. It's been a while since we uploaded a video on GInvest by GCash. We knew after all of those first months when the platform came into play, many of you actually became active on it. Some people watched videos, some people learned about it, and many actually executed and started an investment. How about you? Have you started yet? Maybe it's high time you begin your journey now. It's easy and simple. It's so affordable. 50 pesos to 1,000. That's an easy hurdle for many of us. And most importantly, we only need one ID. Very simple information to provide and fill out. We get the hassles of long forms and too much data to supply out of the way. So maybe you should consider doing it immediately. How about those who have already started? What does it feel like? Are you proud that you're now an investor, not a spender? Do you feel good about this? Are you confident? Because some of us are actually making little money by now. Or you may be uncomfortable and worried because there are people who've actually made positions and NABPUs actually went down. Net asset value per unit, the price of the shares went down, which meant they might be losing money. So what's the emotion for you? I have to ask you two questions. Number one, have you made more than just one investment? And number two, have you invested at the very least into 2 or 3 funds? And better yet, in all the funds? Maybe the clincher question is, have you made a one-time big-time investment? Or are you proceeding with an investment strategy and program that makes you commit to put a certain amount of money in a specific choice of funds, a number of funds, every 15th and 30th of the month? You see, that's the reason why this is a very, very important message. Let me remind all of you that GInvest by GCash is an enabler. How we're going to do well on this platform is not going to be dependent on the platform itself. It will depend on our behavior and how we manage ourselves in this journey of investments. As promised, I'm going to be here to handhold you within this investment journey. My promise was to give follow-through advice that will help you navigate this investment track. So let us get on with this. Number one, have an end in mind. What are you doing this for? You're not doing this just to earn money. You're actually doing this to achieve a financial goal. What goal is that? Is it for a child's education? Is it building up a down payment for the condo or the home of your dreams? Are you thinking about traveling maybe in the next few years? Are you thinking about retirement and the funds that you're going to live by in your twilight years? You don't invest to simply make money. You invest to particularly achieve a goal. What goal is that? And what are you thinking of when you made this commitment to invest in this platform? And as you identify that goal, maybe you also have to define how long that investment horizon is. If it's travel, how many years? 2 years? 3 years? If it's retirement, how old are you right now? How long can you have in terms of a runway to achieve what you want to reach for your retirement funds? If it's a child's education, how old is your child? How far are we from needing the money? I guess it's determining when that enrollment will be. Now, as we know what the goal is and the time horizon, let's check out our risk appetite. Based on the funds that are in GInvest, select a good mix that would probably give you comfort. If you're risk averse, probably veer towards fixed income instruments. If you are very comfortable with risk, you can actually push yourself towards the growth area, which would mean equity-laced funds, the funds that will have stocks in their portfolios. But how much of a risk taker are you? Are you going to keep yourself within the local arena? Or are you going more for the global funds, like the Global Consumer Trends Fund or the Global Technology Feeder Fund? See, your decision here has to focus on a certain asset allocation program that you're going to define. How much of the portfolio will be in the money market fund, in the bond fund, in the stock index fund, and in the global funds. And you have to know what that percentage is. So month on month, as we contribute, you are seeing this taking shape with a kind of weighting that you define from the very start. You have to follow this allocation program until you review and redefine certain goals and risks that will allow you to probably change, rebalance and reposition into the future. Number 2, be ready for volatility. Brace yourself for volatility. You have to know that it will happen and it's bound to happen. Take a look at all of the charts. All of the charts of the UITFs that are in GInvest. None of them are moving in straight lines, and we cannot even say that it's doing all of those movements in one direction. There can be gyrations over time. The trend can look upward, but there are up and down movements. As Peter Lynch would say, you have to be ready for the volatility. If you're not ready for the volatility, then you're not going to do well in these markets. You are just going to be emotional. You have to know that the fluctuations will come. Now, let me be very clear. If you're not comfortable with that, and you'd really want something that's different, maybe you're going to be more matched to a fixed income instrument. And since it's going to be that guaranteed instrument, maybe you're going to be better off investing in GSafe. It is not going to fluctuate. It is not going to go up and down, but you'll have to be happy with a relatively low rate that will not have a growth trajectory. You see, low risk, low reward. High risk, high reward. But you see, sometimes risk can be managed by the horizon. By having more time in the market and not needing the funds, you can actually let them stay there, and no matter how the fluctuations go, you will rest in the idea that you don't need the money today. You will need them for the achievement of your future goal. So what is most important is the value by that time, not today. See, investing for the long term requires a long-term perspective. And if you're going to realize this and make sure you manage your emotions using this, you will get to see that sometimes many of the things we do are not productive. And many of the things we do are not going to be helpful. Think about this. This is an analogy I will be giving because it's very, very relevant. We all go to New York. We want to go to the Empire State Building. We're tourists. You go to the top of the Empire State Building to marvel at the view of downtown Manhattan. All the nice skyscrapers and buildings. You get into an elevator. Unfortunately, it went down. Will you get out of the elevator when it goes down to the basement and try to look for nice views? All you will see will be a dark parking lot with a lot of cars. That's not what you want to see. You want to see the view. So you will have to patiently wait for the elevator to go up to the top deck. And in which case, you get out of the elevator and go around the place to see different perspectives of Manhattan. You try to look for the view when you're up there. How come we're not doing that for our investments? It is when markets are down, it is when NAVPUs are down that we get to check these values each and every day. It's almost like, oh, it went down the basement and you're trying to look for a view. Be patient. Let me assure you, that elevator will go to that top floor. Markets will go to an all-time high. It's a matter of time. Am I going to say end of this year? No. Am I going to say end of next year? No. I don't know. I don't know when it's going to happen, but it will happen. And won't I have the patience to wait till that happens? I have to be able to do that. Besides, the mindset is this: do I need the money? I ask you that. Why are you looking for the valuations today? Do you need the money? There are times when I get to ask people, oops, you did this for your retirement fund, and the fund values have gone down. You're worried. Question I have is, are you about to retire? Are you retiring this month? You see, it becomes relevant to you when your horizon is that short. In which case, I'm going to tell you, then that money shouldn't be here. That money should be somewhere else where you can draw out in a few months. Money that would be in these funds should be set forth so that you fulfill longer-term dreams. In fact, the examples I set forth earlier are all longer term. And this is, I think, the most powerful perspective of all. You know what? For people building up on their base for their future financial goals, their mindset will be very different. Let's just say the market goes down. Some people will be very sad. Some people will be very worried because they're losing money. But the astute investors will think something else. Wow, I'm being given more opportunities to invest. And if I'm going to be investing, the prices are still cheap. In fact, they got cheaper. So much so that when I come in, I buy more shares. So that in the future, when my child is about to get on with college, by the time that my wife and I are going to be traveling, or by the time I will be hanging up my gloves for retirement, the values will be high. But it's an opportunity to get in today. Now, the market has gone up. Some people will be saying, wow, I'm really happy with this. I'm earning money. But you know what? Astute investors will say, oops, I don't need the money yet. I'm still building it up. So now, it is unfortunate that the market is up because if I'm going to be putting money now, I'm going to be getting less shares. So try to see that. For a person in the process of building up a fund, it is actually good to have lower NAVPUs because anything that you're going to be putting in will be put in at a very good price. But when markets are up, you're actually getting forced to make investments at a higher price level. That's kind of enlightening, right? That's a very, very different perspective. So my question to you is this: you want to feel good now that you've invested very little, still way far from your real goal? Or would you want to be happy later, which means today you'd want to be able to invest at bargain levels? So instead of feeling bad that NAVPUs are down, you have to feel good that you're investing today at lower prices. Number 3, GInvest funds are UITFs, Unit Investment Trust Funds. Check out my video on a very comprehensive discussion of these products. But the important thing is to understand that they are managed funds, which means if you're invested in a UITF, you actually hired a fund manager. There is a fund manager who pulls the money of all investors and manages this for you. And that's why I'm kind of surprised. Many of you are watching the funds every day and even thinking about switching funds on a constant basis. Isn't your fund manager supposed to be the one to deliver you value? If you're going to be looking at how to move monies almost on a daily basis, guess what you're doing? You're not letting the fund manager manage your funds. You're actually managing the fund manager. By doing your trading and shifting within the funds. I don't disagree. You can do this after periodic reviews and in due time where you think you can make longer term adjustments in your portfolio. But on a daily basis to do that, you're actually trading. You're not investing. Your job is to stick to your discipline. You've made the commitment to build up the funds, to have a certain weighting or allocation. Your job is to be responsible and accountable that your inflows, your investments happen consistently at the right times. The fund manager's job is to create that value for you, that no matter what's happening to those markets they are part of, those funds are supposed to provide better returns than what you can do on your own. That's key. So let us not manage the funds very closely because it's going to defeat the purpose on why we invested in the first place. But as I've mentioned, you will have to review your position, your portfolio periodically. That's number 4. It is okay to do that because every now and then, you will have to make 2 particular reviews. One review will be a review of your goals. There are times when you also change your particular needs. When you started your investments, you were looking at this particular goal. At a certain point in your life, that might not be important. You might want to make a shift. So a change in goal requires a change in the portfolio, the change in the weighting. Or maybe it can be driven by performance, so much so that you might want a bigger commitment in certain funds that are performing. But for the others, it can even be the other way around. If you've made a ton of money in a certain fund and you're only comfortable to have a certain level of risk in that portfolio, maybe the bigger idea is to take earnings from there and put these into safer instruments that don't fluctuate too much anymore. So again, it always goes back to goals, to that risk appetite, and you will use this to review what you need to do on the funds. Number 5, I want you to commit to your investment strategy. Commit to your investment program. You've set forth certain parameters. Stick to them. Be patient. You know the stone cutter? Hammers on a stone. The first 10 blows don't even show so much of a crack. But the stone cutter knows in about the 100th blow, the stone will break up. He's patient enough. As investors, we do this very differently. We just throw the hammer twice or thrice and we want the rock to break immediately. That's not the way to do this. It is a long-term horizon. You've set up long-term goals. That's the reason why you have to be patient and see how your portfolio performs well over time. Not temporarily, not on a short-term basis. It will just put you in a position of a potential behavioral misery. Negative emotions come in when you always look at it, it's down again. Oh, it's up. It's a roller coaster. But as I've said, do you need the money now? When do you need the money? And what you needed the money for? When you think about those, your behavior changes, your perspectives change, and guess what happens? You're going to be more attuned to what you want to accomplish. And lastly, number 6, continue your learning journey. Try to understand your investing a little more. Review the funds. See, was there a change in their portfolios? Why is one performing better than the other? As we appreciate what the fund manager does, we're going to be in a better position to make movements for the future. Always try to educate yourself. The more investment acumen you have, the closer you'll be to success into the future. And that's the reason why I say, watch more of our videos, review them, and moving forward, watch out for what we're going to be coming up with. In the meantime, commit to whatever program and track you set up for yourself and make sure you follow through. Again, as I've said, whether in sports or in investment, following through is most important. All of these things that I've said might put you in a better perspective to be happy, to be comfortable, and to be confident and optimistic that what you're doing is right. Again, this is Rex Mendoza. I assure you, Rampver Financials will be here for you in your journey in fulfilling your financial dreams through GInvest by GCash. Until our next video, I wish you all the very best. Blessings always.